Valentin, let me kick it off with you. Does it actually, so we're a little bit thin in terms of economic data, this week. So how much will the bond auctions actually steer us in what yields will do next?
Ultimately, it's about supply and demand. And what's been interesting, the latest price action in the fixed income markets on the whole, focusing on a 10-year tenor, if you wish, is that most of the correction high we've seen so far is due to the repricing and inflation really being higher in the US down the road. What we have not seen yet is an adjustment in the so-called term premium, which is really a measure of the expected imbalance between supply and demand of paper. And this week, in particular, we're going to see quite a big pickup in supply, which will continue to contrast with the receding demand, especially from the Fed. So ultimately, I think I'll be really watching what's going to happen to that term premium as a longer-term driver of Treasury yields. My expectation would be that, given the term premium at the moment is still negative, right, and they should not be, that normalization of those term premiums should drive Treasury yields higher still, even in the absence of fundamental data releases. Okay,
and I want to talk about financial conditions, and I have a great chart which I'll come to in a second. But Simon, within your reporting and within your editorial duties, what will you look out for in the next 10 days?
A great story on the Bloomberg today by Steve Matthews looking at the Fed minutes and this word that has appeared in the minutes. The word is further, and in the last statement they added further ahead of gradual increases, and so this has got the criminologists who watch the Federal Reserve wondering what this means. Does it mean more rate hikes than the 3 that are penciled in? Does it mean that the Fed thinks that the neutral rate, that gap between boom and bust interest rate, whether that's moved higher? And so there's going to be a lot of time spent poring over those minutes trying to work out what further means, whether it means that 4 rate hikes that Goldman and Barclays and others see, or whether the Fed is still on course for 3 as its own dot plot shows.
Valentin, what do you think further means?
Well, we stick with our 3 rate hikes call for the time being, but I would agree that the risk is for 4 really for this year, and the hikes extending into 2019, and the market is moving that way. So, I mean, if you look at both, really, Fed rate hike expectations plus the term premium, all that seem to point at higher Treasury yields, potentially heading to 350 before long down the road. Yeah.